In the pursuit of growth and expansion, businesses are constantly faced with the decision of how to finance their operations. Two primary sources of funding, debt and equity, each come with their own set of advantages and risks. The choice between debt and equity financing is one of the most important financial decisions a company makes, as it not only influences the company's cost of capital but also its control, flexibility, and financial health. While debt can offer tax benefits and a lower cost of capital, it increases the financial burden and risk of insolvency. Equity, on the other hand, allows companies to avoid repayment obligations but dilutes ownership and may prove more expensive in the long run. Striking the right balance between these two forms of capital is critical in achieving long-term sustainability and maximizing shareholder value. To explore a deeper analysis of capital structure strategies, let's break down some key aspects and strategies for optimizing the mix between debt and equity. The ideal capital structure varies depending on a company's industry, growth stage, risk tolerance, and goals. Here's how to approach this analysis. 1. Understanding the capital structure. The capital structure of a company refers to the proportion of debt and equity used to finance its operations and growth. Striking the right balance can reduce the cost of capital, minimize risk, and improve profitability. 2. Leverage ratios and financial metrics. To assess a company's capital structure, certain ratios and financial metrics are key. These include: A. Debt-to-equity ratio measures the company's financial leverage by comparing its total debt to shareholders' equity. Formula: debt-to-equity ratio equals total debt, total equity. A higher ratio means more debt relative to equity, which increases risk but also potential returns. B. Debt-to-assets ratio shows the proportion of the company's assets that are financed by debt. Formula: debt-to-assets ratio equals total debt, total assets. This ratio helps gauge the risk of insolvency, especially in capital-intensive industries. C. Interest coverage ratio measures a company's ability to meet its interest obligations on debt. Formula: interest coverage ratio equals earnings before interest and taxes, EBIT, interest expenses. A lower ratio indicates potential difficulties in meeting debt payments, while a higher ratio suggests strong debt servicing ability. 3. Cost of capital and WACC. The weighted average cost of capital, WACC, is a critical calculation in determining the company's optimal capital structure. It measures the average cost of financing from both debt and equity. WACC formula: WACC equals E V asterisk RE plus D V asterisk road asterisk 1 TC, where E equals market value of equity, D equals market value of debt, V equals E plus D, total firm value, RE equals cost of equity, expected return for equity investors, ROAD equals cost of debt, interest rate on debt, TC equals corporate tax rate. Since interest is tax deductible, lower WACC indicates that the company can finance itself more cheaply, which improves profitability. A company can minimize WACC by finding the right mix of debt and equity. Usually, increasing debt can lower WACC because debt is cheaper due to the tax deductibility of interest. 4. Factors influencing capital structure. Several factors can influence whether a company chooses more debt, more equity, or a balanced mix. A. Industry norms. Certain industries are more debt-intensive, e.g., utilities, manufacturing, due to their capital requirements, while others, like tech and service industries, may rely more on equity for flexibility. B. Business lifecycle. Startups, high-growth companies. These often rely on equity because of the uncertainty of future cash flows, which makes it difficult to meet fixed debt payments. Investors are typically more willing to take on the risk for potentially higher returns. Mature companies. Stable companies with predictable cash flows often rely on debt, as they can manage interest payments and benefit from tax deductions. Debt financing is generally cheaper and less dilutive for established firms. C. Market conditions. During periods of low interest rates, companies often prefer debt because borrowing is cheaper. Conversely, when interest rates are high, equity becomes more attractive. Market sentiment can also affect the ability to issue new equity at favorable prices. If investors are bullish on the company, equity can be raised with less dilution. D. Risk tolerance and ownership preferences. Owners may opt for debt to retain control of the company, avoiding dilution that comes with issuing new equity. However, the higher the debt, the greater the financial risk, which could lead to insolvency during economic downturns. 5. Capital structure strategies. Here are several strategies companies use to optimize their capital structure. A. Target debt ratio. Many firms aim for a target debt-to-equity ratio based on industry standards or corporate goals. For example, they might aim for a 50-50 mix to balance risk and return. B. Debt-financed growth. Companies with predictable cash flows often use leveraged financing to fund growth. This strategy increases financial risk but also boosts the company's return on equity, ROE, if the investments made with debt capital generate returns higher than the interest cost. C. Pecking order theory. The pecking order theory suggests that companies prefer to finance their operations in the following order: internal funds, retained earnings, debt equity, as a last resort due to the dilution of control and higher costs. This theory assumes that managers prioritize financing methods that minimize information asymmetry and market signaling issues. D. Trade-off theory. The trade-off theory balances the benefits of debt, tax shields from interest deductibility, with the costs, risk of financial distress. Companies aim to find a balance that maximizes firm value without increasing bankruptcy risks. E. Adjusting for economic cycles. Smart CFOs adjust capital structures based on economic cycles. During expansion, they may take on more debt to fuel growth, while during downturns, they may reduce leverage to ensure flexibility. 6. Recapitalization. Recapitalization involves restructuring a company's debt and equity mix. Companies often use it to lower WACC, refinancing debt at lower rates, or issuing equity to repay high-interest debt. Restructure ownership. A buyback program reduces the number of outstanding shares, increasing earnings per share, EPS, and potentially boosting stock prices. 7. Real-world example. Apple Inc. Apple is a great example of capital structure management. Despite having significant cash reserves, Apple issued billions in debt in recent years because interest rates were low, and the company could benefit from the tax shield on interest. Apple balanced debt financing with share buybacks, reducing its equity base, which increased EPS and shareholder value while keeping the overall cost of capital low. Ultimately, the decision between debt and equity financing is not a one-size-fits-all solution. It depends on your company's unique circumstances, its growth stage, risk tolerance, cash flow, and strategic vision. By understanding the strengths and challenges of both debt and equity, businesses can craft a capital structure that optimizes their cost of capital, maintains control, and positions them for long-term success. Whether you choose to leverage the stability of debt or the flexibility of equity, making informed financial decisions is key to driving sustainable growth and maximizing value for your shareholders. Remember, the right financing strategy is the one that aligns with your company's goals while ensuring you have the financial flexibility to navigate an ever-changing business landscape. Thanks for watching, and here's to your continued financial success.